Okay, we'll get our analyst, Rajiv Mehta, the banking analyst at IIFL, is on the phone line, and we'll have more experts joining in. Your first thoughts, Rajiv? 25% profit growth?
Yeah, the numbers look decent because the PAT as well as the NII numbers are pretty much in line with our expectations, and rather the asset quality, we just thought we might see some deterioration, but it almost stable on sequential basis. We would, I think, be wanting to more look at the incremental slippages in the quarter, which we were estimating at about 10 to 11 billion as compared to about 8 billion in the previous quarter. So if that number is not that, is not showing such a big kind of an uptick, then the numbers are pretty healthy.
But would you worry about the future performance, not because of anything wrong that the bank is doing, but because of the manner in which money has gotten tighter, especially for private sector banks who, run a very tight cash position, both because of that higher cost and because the economy is continuing to wobble? Do you think this quarter will be a bigger challenge?
Yeah, of course. So incrementally, we will see more hardships as far as the private sector banks is concerned in terms of asset quality, and maybe also in case of NIMs, and especially for ICICI Bank because it is also significantly in a way wholesale funded. So we have seen the best of the NIMs as far as domestic NIMs are concerned. They were 3.5% in the previous quarter. We reckon they would have slipped in the current quarter, and they may slip slightly further in the next couple of quarters. But provided if they are able to actually make up at the margin level through significant addition of CASA, then we are not looking at such a big dip in the NIMs on an overall YOY basis in the current year.
Okay, Vaibhav Agarwal, the banking analyst from Angel, is also joining us. Vaibhav, your first thoughts? It's a 25% rise in profit and stable assets.
I think broadly on virtually all the parameters, the results do look in line with estimates and a strong set of numbers, continuing their trend of previous quarters. Of course, it would be interesting to watch their guidance. At the beginning of the quarter, they had talked about a higher loan growth of about 20%, assuming 17% industry growth. So, of course, with the new environment, whether they really, see growth challenges would be interesting to watch for. But otherwise, they look quite set as far as asset quality and operating performance is concerned.
Vaibhav, hi. The stock has fallen quite a bit in the last couple of months, of course, moving in tandem with the market. But now, how do you approach it, considering that relative to the rest of the banking space, the performance is very good?
Well, clearly, with the way the environment is shaping up, we remain quite cautious on the banking sector as a whole. But, within that, HDFC Bank has been our top pick. And, after that, certainly ICICI Bank would be our next preferred pick, considering the management quality, the large amount of capital and CASA that they have. Overall, definitely, relatively, they are better placed than most of the other banks.
Okay, I think the advances growth is about 12%. 2,68,000 crore a year ago has become about 3,01,000 crore. Vaibhav, at 12% volume growth, would you think that there is a danger of volume growth remaining lower than what most analysts expected?
Yeah, actually, clearly 12% does look on the lower side.
1 minute before I come to that question. Net interest margin is actually a tad lower. 3.27 is what they have done. Quarter on quarter, that is lower because they've done 3.33 in the previous quarter, not full year, in the previous quarter. Vaibhav, margins already under pressure. Do you think that would constitute, both margins under pressure and volume at 12% growth will also be something to worry about in the quarters to come?
Actually, margins we would not be unduly concerned because 3.33% was an all-time high for them, and the management themselves had guided that it was not sustainable at that level, and some decline was expected. But on the volume growth, we are concerned because at the end of the day, they do have a large 25% in overseas loans, which is not growing. Even their they have large exposures to power and infrastructure. So clearly, it's only that 35% in retail loans which is seeing or expected to see growth. So growth clearly is a challenge for ICICI at this point.
Okay, the domestic net interest margins have also come in 3.63% versus 3.77%. So on a quarter-on-quarter basis, there's a bit of a slip. The restructured loans have come in at 600 crores this time around. Rajiv, how do you approach the stock at this point? Seems like the stock is actually recovered right now because the numbers are pretty much in line. But going ahead, would you be concerned about the slowdown in the overall system and thereby on loan growth?
Yeah, of course, we are worried about the volume growth slowing down going ahead, as well as the margin movement in the context of what RBI has done and what is the monetary policy outlook. So overall, see, we are not looking too much at valuation at this point in time, because I don't think the market is looking at valuations as far as private banks are concerned, but it is rather the incremental news flow as well as the news with respect to the economy and the way it's going to pan out, the recovery is going to pan out. That is more important. So it's of course a buy from our perspective, but I mean, it will be very difficult to expect a very strong outperformance of the overall banking sector, and especially even ICICI Bank in that context in the near term.
On
go ahead.
On asset quality itself, Rajiv, the provisions have gone up a tad bit this time around on a quarter-on-quarter basis. Going ahead, do you think a bank like ICICI Bank will have to provide for more given the situation, and thereby asset quality might see a drip poison sort of a deterioration?
Well, just a word on that, Rajiv, before you answer. Provision coverage ratio has fallen a bit from 77% to 75.4. This is natural. When you create 400 crore more of gross NPLs, some bit of it will give you an idea of what the slippages would be. I think it was 600 crore additional slippages. So obviously that would have led to the slightly lower provisioning number. It wouldn't have meant that they are providing less by RBI standards. They would have provided more. But that incremental slippages would have led to the provision coverage ratio looking lower at 75.5. Sorry. Rajiv, you were talking about asset quality?
Asset quality, yeah.
Yeah, so asset quality trends will determine the valuation and the stock price movement, and I think that trend will continue to be slightly concerning for private banks going ahead, given the fact that the entire economy will be under stress for a prolonged period of time. That is what our view is. So we may see the trend continuing in the coming quarters as well, wherein the gross NPAs, which are actually kind of declining quarter on quarter, may see slightly going up marginally on a quarter on quarter basis.
Okay, is Vaibhav still with us? Vaibhav, what's your call on the stock now?
So like I was mentioning, I mean, it would be relatively a better stock to hold in the sector, but, and definitely from a long-term value point of view, there is value. Of course, in the near term, I think it would all depend on the sector's performance. So, it's really, I think target prices don't matter as much as, the relative call over here. From that point of view, it is a better one to hold within the sector.
Rajiv, we don't have the slippages number just yet, but what is your expectation this time around?
Number of 10 to 11 billion, and from the gross NPA movement, I think the slippages could be slightly lesser than that. So that could be a relative positive within the number that we have not seen the kind of slippage what the market was expecting.
And how are you positioned on the stock? I mean, it's fallen from 1200 to 900 right now in the last couple of months. But what kind of a target price do you have?
Yeah, so our earlier target price was around 1300, but we'll have to actually we'll have to relook at it, because we'll have to listen to the call and what the management is guiding as far as the growth is concerned and the credit cost guidance is concerned. And overall also we have actually slashed target prices across the board for banks, which has been a combination of assigning a lower valuation multiple, at the same time cutting the absolute earnings. So we may see a downtick in the target price, but still I would want to agree with Vaibhav that if somebody is looking at an investment horizon of 9 to 12 months, then ICICI Bank is undoubtedly a better bet amongst the large cap private banks.
Okay, I think